That leads us nicely into the growth potential of the business. So a key part of that is where Mercia sources the capital it deploys to those businesses. Can you tell us a little bit about where that comes from currently and how it might change over the next few years and longer term?
Yeah. I mean, at the heart of everything we do is sort of risk mitigation, whether it's for our clients, whether it's for our shareholders, and that is really to do with diversification as well. So diversification, whether it's those asset classes I just talked about, or actually the capital that we manage underneath that. And we manage three pools of capital. We manage retail through venture capital trusts, VCTs and EIS. We manage public sector capital, and that for us is predominantly British Business Bank.
Yeah.
And we manage institutional capital, whether that's local government pension schemes or further institutional capital. So those are our three pools of capital that we manage. And then those asset classes above, venture, development capital, property finance at the moment, those three areas are all in growth metrics. Okay, so and it's a very exciting. I think venture for the UK is a relatively new asset class compared to the other areas, and that is definitely in growth. And we may well get onto the Mansion House, etc. But that is pointing to private capital, and we only manage private capital, but is a specific sort of drive into venture. And if you look at the sort of total addressable market of venture, there was about between 4 and 6 billion invested last year. And so in the full year, that's how much was invested. And we invested in the sort of the comparative year about 131 million. So if you were to say, okay, well, it's reasonable to go after 10%. Let's treat that as a 10% market share. So 400 to 600 million. We're doing 131. We can easily double our position. So with me, I look at venture and say, okay, how do we get our 1 billion to 2 billion while still delivering what our investors expect from us? We see the origination that supports that, and so we see the growth trajectory that supports that. You come on to development capital and you're in a sort of 5 to 10 billion type of market share, and we're absolutely just scratching the surface, less than 100 million being deployed there. So again, you can do the 10%, follow it down, huge growth opportunity. And then if you go into property finance, that's in the sort of 10 to 15 billion market within our market segment. And again, we're investing less than 100 million in there. So again, you look the 10% flow through, plenty to go for there. So in terms of deal origination and opportunity, all of those markets are in growth, and we believe we can greatly grow into that. Then if you look at the capital sources below, retail, for us it's VCT and EIS, and EIS is typically sentiment driven, and that is a tough market at the moment. So I say EIS is a hard group market for all players in EIS. That's a struggle. So that market at the moment is fairly static, and one hopes that will grow, and some of the initiatives that have come from the recent autumn budget, for instance, may well help that. Okay. British Business Bank, that has got an increased amount of capital allocated to it. We like to think we are an effective and trusted partner, and we believe that there's much more growth from that source of capital to come for us being that partner in its delivery. And then institutional capital historically has been challenging, and we can talk about that maybe later on, but there are a number of initiatives trying to redirect that capital. We think that is a growth opportunity in the sort of medium to long term.
Okay, well let's dig into it now. When you say institutional capital, who is that? Yeah. And how much could they move the needle? Did the 2 billion get to double, more?
Yeah, and one of our, as I said, our core values, one is growth. And I'm a great believer in you're shrinking or you're growing. There is no such thing as standing still. So you have to have a growth mindset when you're looking at all parts, whether it's our businesses we're backing, the projects we're backing, or ourselves as an asset manager. See, within institutional capital, subsequent governments, and not just the existing government, have been trying to drive a peculiar dynamic. And that peculiar dynamic is if the UK was an asset manager, Mercia asset manager, if the UK was an asset manager, there's about 9 trillion under management across the UK. That would make it the second largest asset manager globally behind the US. So quite impressive when you think about it. So okay. And then, so of that money, how much is deployed domestically? So the US, of their capital, they deploy about 60%. France and Germany, about 40%. Japan, 50%. Australia, approximately 45%. UK, less than 4%. So second largest asset manager, deploying less than 4% of that in the UK. And that really is behind what was initially the Mansion House Compact, became the Mansion House Accord, was to try and redirect more of that money domestically and redirect that money into the private markets. of which AIM, we're an AIM-listed business, is deemed to be a private market. So AIM is part of that philosophy.
Yes,
Can you point institutional capital? And what that institutional capital is predominantly DC, so defined contribution pension capital, it's insurance. So you have a number of parties that have signed up to the accord, and we're talking to many of them actually, about a medium to long-term commitment to direct more capital into the private markets, into the domestic private markets. And that, I think, will be a catalyst of growth in the private markets and is an exciting tailwind that we're just on the edge of at the moment. And it's not being legislated, so it's really being seen as something, a request to move into. But I have been very pleasantly surprised by how that is moving at a pace now. And so I think that's good. That's good for the UK. It's good for the regions, and that's something we're really, really passionate about. And it's very good for the private markets too.
Right. So potential there for some big chunks of capital to come in.
There is, and always, and it's back to the very beginning of the purpose I was saying about, which is sort of wealth creation, prosperity, etc. It's always on the back of track record. These are people are saving money into their pensions for their own retirement and long-term returns, so they want to back managers with a track record of delivery. We've got, so for instance, we have a fund called the Evolution Fund, which we've done the first close, doing the second close. That's on the back of two other funds we've done before, operating at IRRs of between 12 and 15%. Very attractive, good return. It's those sorts of funds that institutional capital are it's a private fund going towards, because they can see how they're doing the right thing for their clients. And that's the important thing, is track record, managers that deliver against expectations.